Dave!
Hello.
Hello!
Welcome, guys. How are you?
Welcome back to another episode of Paris and Baz Cast. Topic of discussion today. As you would have seen, the inflation numbers came out yesterday. Sorry, I just have to compose my thoughts here.
Yeah.
The inflation numbers were released yesterday. For the 12-month period up until June, inflation has gone up 6.1%, which was higher compared to the previous quarter as well. So not in the ideal band of 2 to 3% where our government likes to keep it, which means that there's some aggressive policies, a little bit more of pain coming our way in terms of higher expenses. And the topic of discussion today is what are some of the ways that you can save on your biggest monthly expense, your mortgage repayment. So
There's a number of ways.
We've identified top 5.
Yep.
We're going to talk about that. This is an open forum, so if you do have any questions...
There could be other ways as well.
Of course, exactly. So this is an open forum. Feel free to ask questions as you go. We'd be more than happy to answer. Today we are live on Facebook, Insta, and TikTok. So lots of viewers everywhere. So to discuss, let's start off with mortgage repayments. Let's say if you are getting your first loan, what are some of the things that you can do when you are getting a new loan that can help with reducing the repayments?
So obviously, the interest rate, looking where you're getting the best rate on the market, which lender is offering you the sharpest rate. You can look at your deposit. Bigger the deposit, the smaller the loan amount, and therefore the lower interest you'll pay over the life of the loan. Traditionally, when we write a loan, we normally do a 30-year loan term. But if you have the capacity to do a shorter loan term, that could be another option as well. But if you do that, it probably reduces your borrowing power. So these are a couple of things you can look at when you're purchasing a property. So longer the loan term, so 30-year loan term, then your payments are obviously smaller, so you can borrow more. If the
longer the loan term, the lower your repayments.
Repayment, yes, because you've got more time to repay the loan.
You've got
you'll be paying
lesser...
But you'll be paying more interest over the life of the loan because you got the loan over a longer period of time.
Okay. So there's a saving on a long term as well as a short term. Reducing your term of your mortgage from a typical 30
to say
25,
depending on your circumstances. A lot of I see where people go wrong is when refinancing, when they're probably a couple of years into the loan, and when they refinance, they still refinance on a 30-year term. So yes, the repayment does go down. But effectively, if you keep the loan over that period, you'll be paying more interest. But in some instances, the customers still want to keep a 30-year loan term because it increases their borrowing power. And they can use that cash towards buying another investment property and hope for capital appreciation, which will obviously pay down the debt in the future.
There you go. Okay, so there's an important catch to remember that a lower term will reduce your repayments in the short term and the long term because you end up paying less interest, but your borrowing capacity reduces.
Because your repayments will be higher over a shorter period of time. It's like when you do a car loan, you do it over 5 years, and the repayments are normally high because you're paying the car loan back in 5 years' time. There you go. And another way to probably reduce repayments is refinancing. Look at what you're currently paying on your current home loan. Interest rates are fluctuating pretty quickly at the moment. So it's probably a bit hard to gauge if the best deal on the market today will be the best deal on the market in a month's time because there's another RBA meeting next Tuesday.
That's right.
So they're predicting another 0.5 rise, potentially 0.75. But they're predicting 0.5 increase for the next 3-4 months until November. So it's interesting to see where the rates do end up, but they are certain to go up. They will not stay at where
of course. Look, they have been low for way too long, and I think they're sort of going to that sort of normal range, which has been for some time. However, there are other factors now that are affecting inflation and the budgets overall, household budgets overall, and it's not just demand-based interest rates, which is where it's very interesting. For those of you that follow our stories, you might have noticed also we did a feature on the fact that RBA's, the effectiveness, so there is an inquiry at the moment where the effectiveness of RBA's ability to be actually decide on a monetary policy, your cash rate, is being reviewed. Whether cash rate is something that is going to be it's effective enough to control that aspect, because it is a currently a demand-based. Who is that?
Let's get someone. Yeah.
Yeah.
1 second.
I've got someone on the door. So it is currently a demand-based, the RBA, the monetary policy is controlling the demand, but not so much supply. And currently the issues that we are facing is supply-based as well, which is what's causing the increases in the pricing. So far we have discussed the term of the rate. Okay, we've got someone unexpected. So far we have discussed the shorter term, having a shorter term of your repayments being the first factor. So one of the ways to reduce your mortgage repayments. Secondly, we've discussed is your to be able to refinance into a better interest rate. Now, let's talk about what interest rates are at the moment. Like, what are we currently at? And where, if you are refinancing, what's the process like? What's the term like?
Yeah. So with the variable rates, we're looking in the 3s at the moment.
Yeah.
We're talking this week. Obviously, next week, they'll probably be
of course.
Higher.
Yeah.
In terms of refinancing, what documentation we're looking at?
I don't know, refinance. What's the time frame of? So, because what's happening right now is because if someone wants to save money now, like say for example, if they're deciding to refinance with another lender, how long until they go to that lender, and that period if there's an increase in the rates already?
So obviously when we're refinancing, we're looking at a probably 2-3 week turnaround time, end-to-end process.
Yeah.
Obviously with variable rates at the moment, the rate that we probably have on the loan contracts, you're probably not going to get the rate when the settlement happens, because the rates are increasing.
That's right. Exactly.
Quite quickly. But if you're doing a fixed rate home loan, if you do a rate lock, you pay a rate lock fee, and then you obviously guarantee that rate.
That's right. That's what we discussed previously as well in some of our other podcasts.
I think that's where a lot of clients have gone wrong. They didn't pay the rate lock fee, and when the settlement happened, they got an increased interest rate.
Let's talk about the fixed rate. So right now they're approximately double.
Correct. So we're looking in the 5s at the moment.
Yeah.
With the fixed rate, so a lot of clients out there they're staying away from fixed rates at the moment.
Yeah.
Because obviously the variable rate is cheaper. So if you can get a cheaper rate in the meantime, why not take it and then fix later on? That's what I'm seeing out there at the moment. So the fixed rates, there's an article I was reading the other day as well. The fixed rates are the lowest they've ever been in terms of people taking out fixed rate mortgages at the moment.
Yeah, exactly.
Compared that to 2 years ago, the fixed rate mortgages with the rates were doing a 1.79, 1.89.
Exactly, and now they're 6+, so
5+, yeah.
5+.
Yeah. By heading closer to 6%, depending on which lender.
Yeah, okay. Now let's talk about another way to reduce your repayments: offset accounts. How does that work?
So offset account basically you can most of the time only have an offset account if it's a variable home loan.
Yeah.
So more funds you have in your home loan, in your offset account. So it's just a normal transaction account. The less interest you'll pay on your home loan.
Yeah.
So that just offsets the interest that you pay. So interest is calculated daily and paid monthly.
There you go. So you are, if we've got a savings account, it makes sense to have an offset account. Are there any shortfalls? Anything like any reasons why you wouldn't have an offset account? Anything else to be aware of?
I think there's only advantages of an offset account.
Yeah.
I think sometimes where customers don't understand is what's the difference between an offset account and having redrawing your home loan.
Redrawing your home loan account.
So having redrawing your home loan is basically the same thing as well. You're putting extra funds in your loan, which you can redraw anytime, but it's not acting as a separate offset account. So normally you get that with your basic variable products.
So it's a redraw account?
No, it's just your home loan. Say you have a home loan, $100,000 for example. You can put funds into that loan and you can redraw it at any time.
For a fee, of course.
No fee.
Okay.
A lot of banks have it with no fee. So basically you don't have a separate account as such. But some clients, they want us to have a separate offset account. We can deposit your salary, have all your funds going in. Then it's probably best to have an offset account. But normally with the redraw where you don't get an offset, normally there's no package fee with those loans. So you don't pay an annual package fee. So you save those funds annually, $395 normally.
$395, okay. So we've spoken about a shorter term, we've spoken about refinancing, we've spoken about offset accounts. Let's talk about a larger deposit. What was the other thing? Let's talk about LMI. So when you are getting a new loan, what is the current ratio of avoiding LMI?
So normally when you have a 20% deposit, you will not pay lender's mortgage insurance. That's basically insuring the loan.
Yeah.
So you're
which in turn
high
reduces
risk customer to the bank. That's why they insure the loan. But in saying that, there's a lot of banks out there lending at 90%. So if you're a medical practitioner, doctor, GP, even a sports professional, entertainment professional, we can do 90% without paying LMI.
Yeah, do you think it's risky in today's market given the values are going down?
Look, if you're buying the property well, as we've had numerous discussions before, you hold the property over a period of time, you will be winning. A lot of clients, they want to pay 10% and not pay LMI and borrow 90% and use that extra 10% deposit to buy another property.
Yeah.
So why leverage all the cash in one property when you can diversify your
That's
deposit and buy another property?
Yeah, any money sitting in is dead money, so to speak. But then again, obviously it affects your repayments as
100%.
well.
But obviously you're borrowing more. Your repayments will be higher.
Yeah. Exactly. Okay. And in terms of
and another point is in terms of debt consolidation, I see a lot of clients that when they refinance, they want to pay their car loan off or they want to pay their personal loan off. Another thing to consider there is, yes, you can refinance and do it over 30-year period, but the downside there is you'll be paying more interest over the life of the loan as well.
Yeah.
Because that 5-year, say, car loan or 7-year personal loan, you're extending the loan term out. So yes, your payment will go down if probably ease your cash flow.
Yeah.
But in the long run, you'll be paying more interest. So I know a lot of the lenders these days, when we're refinancing, looking at those shorter term debts, they do want to keep the term relatively similar. Yeah. So the customer is not worse off in the long run.
That's right. Exactly. Yeah. The banks are making money.
So there's a few points there. So do hit us up.
That's right. And in terms of what are your thoughts on interest only and more frequent repayments?
So in terms of interest only repayments, a lot of clients that are buying investment properties normally go for interest only loans. That frees up the cash flow. That basically you can buy another property again.
Yeah, or reduce your repayments, of course.
And the client is relying on capital appreciation in the future instead of paying down the debt.
Yeah.
Whereas there's another school of thought, clients that do still want to pay down their investment property loans, so they do principal and interest repayments as well.
Yeah.
In saying that, when you do an interest only loan term, say for 5 years, and it's a 30-year loan term, you got to remember your repayments over the 25 years will be higher.
Yeah. Okay.
Because you haven't paid no principal down for the first first 5 years.
You've only paid.
So you got to always factor that in as well.
Absolutely.
In terms of repayments, yes, if you pay weekly or fortnightly, you'll be probably paying a little bit less interest instead of paying monthly.
Yeah. So there you go. So that's a big one. So that anyone can do.
Yeah.
You can, every person that has a mortgage, they can change their frequency of payment from monthly to weekly to save instantaneously.
100%.
There you go.
So because interest is calculated daily.
Daily, exactly.
So obviously the more, it's the same as having more funds in your offset account, you pay less interest.
Yeah.
The more frequently you pay repayments into your loan, the less interest you pay.
Yeah.
So yes, all these little 1%ers, they
add up. Right now is, and ever before.
And the more you're ahead of the game right now, you have a bit of a buffer.
That's
obviously
right.
With the rates, they're predicting 6.5%.
Yeah.
So the more you can get ahead, the better you will.
In all these little things, absolutely. There you go. So that's basically most of the mortgage points that we had. Was there anything else that you want to add? Any other ways, tips, tricks on your mortgage?
Obviously, look, we can work out a strategy based on everyone's profile.
Yeah.
Seeing what their current portfolio is, what interest rates they're on, and also planning is loan set up in the right way. Making the maximum tax deductions.
Yeah.
Can we grow? Can we buy another property?
Yeah. And obviously, if you do own an investment property, now is the time for those rent increases to go out. So if you're a property manager, you've got a property manager that's looking after it, do speak to them about where your lease agreement is at. Because before the end of your fixed lease term, if the tenant is not renewing for another fixed term and want to go on a periodic agreement, 60 days prior, they can serve a notice of increase that will come into effect the day after the fixed lease expires. So if you've got a fixed term for 12 months. So definitely speak to your managers about how you can increase your income as well to cover your expenses, increasing expenses from mortgage repayments. Yeah. Now, in general, just a couple. Actually, let's talk about refinancing again. Now, yes, you will save money on the interest, which you potentially would get a better rate with a different lender. I've heard of cashbacks. How does that work?
So a lot of banks out there offering cashbacks anywhere from $2,000 to $4,000.
And some tickets, Qantas points.
You're getting Qantas points as well, depending on which lender we go to. So obviously it is enticing.
Yeah.
We can work all that out for you guys to make sure the switching costs you're in front.
Yes.
So you got a bit of getting tickets or Qantas points or a bit of a cash back.
It's got to work in the favor,
and you're on a better rate as well. So there are deals out there.
Yeah.
So do let us know.
Absolutely. There you go. Yeah. And just quick couple of tips in general. Now, this is not our specialist, field, but something that we have learned over the years and something that we do, for example, on, the second biggest expense being your weekly fuel. Groceries, that's there. Utilities, that's there. But fuel is hurting us all because we are seeing those numbers rise like crazy. There is an app. I don't know if you have used it yet, but if you haven't, I definitely encourage you. It is provided by the New South Wales government called Fuel Check, where you can actually see around you on a map. So you feed in. So if you fuel up 98, for example, you select just that, or diesel or gas or whatever. And it shows you around your circumference what is the cheapest rate, which works so well because if you're going on a certain way, like you're going to work, it does show you on your way what is going to be the best outcome for you in terms of your fuel prices. So definitely check that out. That's helped me a lot as well, specifically every week where it's fueling up. Tuesdays is typically your cheaper days to fuel up. I've got a question here. Will cash rate go up in December quarter if inflation goes up?
Traditionally,
it is going to happen every month. That's the prediction.
Yeah,
but in December.
Traditionally, December, they don't put out the cash rate. That's
right.
What's happened in the past.
Because there is no meeting in January. So, look, it will be interesting to see what exactly happens, but it sounds like before December, every month there is potential for it to go up.
You can increase it and not do one in December as well.
That's right. But the fact that the inflation numbers are 6.1 for the June quarter, because before December quarter, that September number is about to come. And I reckon that's going to be just as high for inflation as well. So that is definitely going to push them to be aggressive. But again, as we discussed before, the inquiry on the Reserve Bank's functionality, effectiveness of controlling cash rate and affecting demand, or the other part, which is currently supply-led inflation, is being reviewed. It's being questioned, which is the right thing to do. Like our treasurer Jim Chalmers is checking. We want to make sure that what is being currently, like the role of the Reserve Bank, is that effective going forward, and how much can you influence? How much can you really increase interest rates, cash rates?
But what you also have to remember is a cash rate of 4 to 5% is pretty normal.
That's right. That's back to those normal days. But there's a lot of other factors now that are affecting, which is making things worse, which is the supply side of things. So fuel, as we've discussed, look at that app. Utilities, for example, look, as you know, these days, loyalty is not rewarded, which is annoying because if you are with the company, you would hope that you would get an annual sort of reward for being with them and getting a better rate, but that's not happening. So one of the things that we from utilities, definitely encouraging you to shop around. There is, once again, a government website called Energy Made Easy, where you can feed in what your readings are on your electricity and gas, and they provide you some options and do some calculations. There's a lot of private comparables websites as well, Compare the PSL, iSelect, all of those. But it's definitely worth shopping around and not giving that loyalty based on what we have seen, that when the longer you stay with a company, that it doesn't typically make the rates stay the same. So shopping around will provide you that better return. Same thing with when you're refinancing, for example. And one of the simplest tips that will make an impact is, those light switches that always stay on around your house. Turn them off. That's the simplest trick. Whenever you are seeing around, whenever you're not in use of those power plugs, turn them off. They apparently have the power of reducing your bill up to 10%. That's not verified, but that's something that I've read. So simple thing like that. I mean, I don't know how much it's going to save, but it doesn't hurt to try. Simple flick of a switch when not in use will help you save there.
It can get annoying, but
I know.
I can't see myself doing that.
And lastly, groceries. Now, one of the things that's happening these days, the rising trend, is online shopping of groceries. Now, in comparison to physically going out there, the studies that have shown that there's actually about $100 difference in a normal weekly grocery shop that you can save if you actually physically go. So online prices are proven to be higher than what they would be if you're physically going into the shop. He's just going, I don't shop. I don't need to know this. Why are you telling me this? Yeah. But hey, people like us have to do the shopping. So these things all add up.
Yeah.
There you go. Well, thank you so much for watching. I am happy to answer any other questions that you might have after this. It's going to be all around on podcast channels as well, and some of the other social media channels that we are not yet live on. And feel free to send us any recommendations for topics that we should cover the next time round. This is a weekly conversation that we have. We bring to you ideas and tips and tricks and share our knowledge about real estate and finance. And make sure you are following our page wherever you're watching this for more real estate and finance advice. Thank you very much for watching.
See you next week.
We'll see you guys next time.